Afternoon, ladies and gentlemen. I'm Eugene from SIAS. Thank you for joining us at Corporate Connect this afternoon. This webinar is organized by SIAS and supported by SGX. Today, we have with us Mr. Geoff Howie, Market Strategist from SGX, to share with us on market updates, followed by a presentation from the representative of Alliance Healthcare Group Limited, Dr. Barry Teng Teck Mong, Executive Chairman and CEO, and Ms. Karen Z, Chief Financial Officer. And we will end off with a Q&A session moderated by Mr. Benjamin Goh, Head of Research and Investor Education from SIAS. Without further ado, let us welcome our first speaker, Mr. Geoff Howie from SGX. Over to you, Geoff.
Thanks very much, Eugene. Let me just try and work out how to make myself visible as well. I am struggling. Hang on, okay, start the video. I should know this by now. Apologies. I just thank you very much for the invite as well. I just want to point out for this next 20 minutes or so, it's going to be a purely, I guess, informative presentation, and recent observations will be on the impact of market drivers on the overall broad Singapore stocks. And that obviously includes COVID-19 constrained growth. It includes interest rate expectations. It includes global trade, demand for commodities, as well as, of course, the at-home corporate efforts to maximize operation efficiency. So if you've tuned in to listen to the Alliance Healthcare Group presentations, they will kick off, I guess, in about 25 minutes. Just as a precursor, this company, it was founded in 1994 and it listed on our Catalyst board in 2019. It is an integrated healthcare group that leverages the use of technology to provide a broad suite of healthcare services here in Singapore. And I might also point out that if you did want to tune off for my presentation, which is more than understandable, because I'm very thankful for SIAS for having the invite for us to present every single month, you could go to our SGX research page, our sgx.com research, and you could read the Alliance Healthcare Group Staying in the Pink of Health interview, which was with Dr. Barry Teng. It was, when was it? It was just in May this year. And then you've also got on our dialogues page a 10 and 10 that we completed with Alliance Healthcare titled Transforming Healthcare Delivery back in June 2020. So that could keep you occupied in case I zone you out a little bit. But getting to the point of it, this year, so far this year, as of the close yesterday, the Straits Times Index, it has generated an 18% total return, which takes the 5-year annualized total return for our benchmark to 7%. Performances of the STI stocks, they have been really varied, from Hong Kong Land gaining something like 48% to Dairy Farm declining something like 13%. And I guess for the 27 primarily listed constituents of the STI, returns have varied from 40% for Untitled to a 13% decline as well for Keppel DC REIT. Now, both Untitled and Keppel DC REIT, they maintain very similar market capitalization. And while Untitled has seen net institutional inflows of around 230 million Sing dollars this year, the Keppel DC REIT, on the other hand, has seen net institutional outflows close to $220 million. And this is followed on for Keppel DC REIT from its 38% total return last year. And in 2019, that REIT also gained, it was 66%, and that helped propel the stock into the STI back in 2020. So while the digital economy continues to grow, the business has noted that progress towards, I guess, the social and the economic normalization that we've seen this year has put less demand on cloud digital services and online services. Untitled has been the strongest of the STI stocks for the primary part of it for much of the year. And it was on the 1st of November, the company reported a gross profit margin of 13% for the third quarter. And that was 14 percentage points less than the 27% recorded a year ago. So that was mainly due to rising material costs, as core shipbuilding revenue did increases by something like 45% year on year. So there's those rising commodity prices having an impact in the manufacturing businesses, particularly shipbuilding. The company did note also that the power crunch amidst the shortage of coal supplies in China, it had led to this electricity rationing that you might have read about. And that basically saw production halt at a number of factories in September and October, but the impact on the shipyards were kept under control, the company noted, and restrictions and constraints on electricity usage have eased somewhat. So the shipyards are now back to normal operations for the company. But on the demand side, global trade, it has been so strong this year. In the first 9 months of this year, I think it was Clarkson's that said the number of new orders placed for container ships had reached the highest level since '96 and surpassed the previous record of 2007. Now, for the STI itself, what's been driving the STI recently is that there are 7 real estate investment trusts that make up something like 14% of the STI weightage, while the 3 banks, as we know, make up more than 40% of the STI. They have been impacted very much by global sector trends this year, and that has provided a lot of sector rotation opportunities actually within the index. For instance, banks were among the strongest sectors of the first quarter of 2021 on the back of this resilient investment activity across the globe and a generally steeper yield curve that's shown in the bottom left chart by the light blue line. Now, that's generally steeper yield curve. It supports banks that generally, as we know, borrow short and lend long. Then I guess if you look at it from May through to September, so from the end of May through to the 22nd of September, to be exact, into this FOMC event, there was a deceleration in economic momentum, and it saw the 10-year US Treasury yields decline from near 1.6% to 1.3%. That flattened the yield curve. And over the 16 weeks, the global banks declined 3% on the flatter yield curve, while global REITs gained 8% on the comparative premium gain of the global REIT yields to 10-year US Treasury yields. And that saw, as we said, that was on those yields, 10-year yields. They declined 30 basis points, remember, from 1.6% to 1.3%, which flattened the yield curve. Saw rotation into the REITs and rotation out of the banks. And those moves across the world extended to the STI. So we had DBS, OCBC and UOB averaging a 3% decline over the period, while for the 7 STI REITs, they actually averaged a 3% gain for that period from May to near the end of September. Interest rates were not the only market driver over those 4 months or so. There were rotations within the sector's industries. For instance, over those 16 weeks, the resilience of global trade saw the 3 STI REITs with logistic properties that include warehouses and distribution centres actually lead the 7 STI REITs. Fraser Logistic Commercial Trust, Ascendus REIT and Mapletree Logistic Trust averaged 6% total returns over the 6 weeks. So through the year, the logistics sector has demonstrated its resilience. Demand for industrial real estate has been underpinned by the manufacturing sector, which not just in Singapore, but across the region has obviously been attributable to the expansion of electronics, precision engineering, and the chemical sectors. So this was probably one of the biggest rotational trades that really drove what happens in our global markets. Now, I know it's US focused, but you've got to remember the US is also something like 25% of global GDP and close to 45% of global stock market capitalization. So what happens in the US and much of the Western world, including China, including ASEAN, does impact does impact Singapore, sorry. In the US, the direction and the conjecture of the monetary policy really is the key market driver. As we know, the Fed will begin tapering Fed assets later this month, but for interest rates, the Fed is pursuing a very different and a more stringent test for the economic conditions that would need to be met before they are hiked. We had a good unemployment number, but as the Fed statement noted on the 3rd of November, it understates the shortfall in employment, particularly as participation in the labour market remains subdued and participation for prime-aged individuals also remains well below pre-pandemic levels. Nonetheless, I am pointing this out because it is important, particularly as the banks are more than 40% of the SDI, that the conjecture and the chat that the Fed participants will make going into the end of the year will be very important. And those Fed participants are encouraged by the Fed chair to speak up, speak their mind in the interests of market transparency. So other overarching, I guess, market drivers, they obviously include the global efforts to contain COVID-19. The global growth outlook does remain pretty much intact for not just this year, but next year. But as we said, rising commodity prices, supply disruptions, and this continued local focus on strategic restructuring are providing the market cues. On the COVID-19 front, I won't go into what's happening locally because I'm sure everyone's well aware of this, but globally, what's happening is very important as well. The 7-day rolling average of the daily new confirmed global COVID-19 cases, it has been declining in recent months and very much down from the 650,000 cases a day that we saw in mid-August. But the key test for the end of the year is for this trend to continue, and the objective of the 7-day rolling average is to break below 360,000 cases per day. That is a key level that we reached in mid to late June and mid to late February. We reached it again at the end of October, but we're yet to substantially or significantly break below it. So that is a key, that will be a key focus. And also, there are gaps in the vaccination rates, obviously, across the countries of the world. I think the IMF said in its World Economic Outlook in October that over half the countries of the world are yet to reach their goal of vaccinating 40% of their population by the end of this year. Also for Singapore growth, the IMF, for the global growth first, it trimmed its global growth outlook for this year very slightly, and kept that 4.9% growth rate intact next year. Similarly, Singapore GDP, it is expected to grow between 6% and 7% next year and remain above trend. 6 and 7% this year and remain above trend next year. As the MAS noted, with that slight raising of the slope of our nominal exchange rate policy band, strengthening external demand and recovering domestic expenditure are expected to sustain a firm pace of growth in the economy in the quarters ahead, okay? And growth in the trade-related and modern service sectors will be supported by, of course, the resilient electronic cycle and improving business activity. So looking a little bit more closer at the banks, because they all reported last week, the trio of DBS, OCBC and UOB, they make up something like 20% of our total market cap, 20% of our day-to-day turnover, and more than 40% of the SDI weightage. They have generated very similar returns over the past 20 years, ranging from 9.9% for UOB to 10.9% for DBS. But since the onset of COVID-19, the trio have been very highly correlated to their global peers. I think since the end of 2019, the trio here have generated 24% total returns, which compare to 18% total returns for the Bloomberg World Bank Index and 22% total returns for the MSCI World Banks Index. DBS has continued to make new highs in recent yesterday over at $32.60, and I haven't had time to check the market today to see where it is. All three provided updates, as we said last week. The combined net interest income of the trio came to 5.17 billion Singapore dollars, which was up from 5.13 billion Singapore dollars in the second quarter of this year, and up from 5.07 billion dollars in the third quarter of last year. In the first 6 months, in the first 9 months of this year, the net interest income made up something like 50% of DBS's total income, 54% of OCBC's, and 64% of UOB's total income. They maintained, DBS, OCBC, and UOB, return on equity ratios of 13.4, 10.4, and 10.2%. for the first 9 months of this year. And by comparison, the average return on equity of the Singapore banks is higher than both the median ROE for the top quartile global banks by market value and the median of the approximate 600 listed banking stocks across APAC. Compared to the previous quarter, in the third quarter, the customer loans grew 4% for OCBC, 3% for UOB, and 2% for DBS. Whereas the year-on-year customer loans, I think, were up 6% for OCBC, 9% for UOB, and 9% for DBS. The DBS third quarter net profit was up 31% year-on-year. 9-month net profit increased 46% year-on-year, and I think the first, second, and third quarters were the highest in its history for net profit. The key growth drivers going forward for the trio, they include digitalisation, broadening of wealth management services, a continued focus on supply chains and growth markets, which can, of course, obviously include the supply chains of the growth markets. But as illustrated in the lower left chart, the wealth management services have been expanding significantly. Combined wealth management net fee and commission income for the trio, it almost tripled from near 700 million back in the first half of 2014 to close to $2 billion in the first half of this year. Now, I wanted to just quickly point this out because on Friday, the STI broke above that 30th April high that it had made so far this year. And then again, it made a new high yesterday. So basically, the January high of the STI, January 2020 high, was 3283.89, and yesterday the morning session made a high of 3270.65, and yesterday's high was the high for the year. But between those STI highs of the 30th of April and 5th of November, of the 100 most traded Singapore stocks, 42 actually outpaced the STI, and those 42 stocks generated median price gains of around 11%, with net institutional inflows of $1.2 billion. Now, aside from the comparative resilience of the energy sector, technology, industrial, and REIT sectors for the period, and those sectors were, as we say, the strongest sectors across the globe, and we've seen a lot of sector correlation with sectors in Singapore and sectors across the globe generating kind of similar returns, if you will, since COVID began. That convergence, I guess, and performances does make sense, given so many of the sectors are facing the same challenges on the COVID-19 front, wherever they are in the world. What we saw is a number of real estate developers in Singapore also led our local market. So it wasn't just, as we say, the key sectors which have outperformed across the world, which are energy, technology, industrial, and REIT, but we also saw STI stocks like Hong Kong Land and Capital Land Investment basically shine and outpace the STI over that 4-month period or so. And predominantly that was because, as we say, the local focus on restructuring and strategic initiatives, which we saw for Capital Land Investment, and then of course Hong Kong Land are pursuing a share buyback plan as well. But this is the list. This is the 20 best performers over the period. Okay. For the 10 stronger performances, RH Petrobras down to Raffles Medical Group. If you look at those 10 stocks, they really are being driven over that 6-month period, not 4 months, 6-month period, by energy prices, semiconductor demand, resilient investment with the likes of iFast and Propnex, and then earnings growth has been a factor, as well as the provision of COVID-19 testing equipment. And of course, as we said, the ongoing strategic initiatives and corporate restructures that have impacted the stocks. So we've got a lot of detail into what has driven these stocks in particular over for their more defensive performances, while the STI basically fell off and then returned to its high. And you can read about those if you like in the latest SGX My Gateway newsletter. What I'd like to do is kind of go a little bit more forward into tech as well, and just note that technology has been a key driver of growth across the global stock market. It's basically the market capitalization of the global technology stocks, it's nearly doubled from a total market value of, no, it hasn't more doubled. It's grown threefold. It's grown from the total market value of all tech stocks listed across the world has tripled from $7.4 trillion to near $23 billion sorry, it should be trillion dollars, $23 trillion as of the end of 2021. So 7.4 trillion to $23 trillion in the space of 3 years. And it means, what it means now is the tech sector is almost twice the size of the bank sector. And given the increasing consumer orientation of tech stocks, the drive for increased tech regulation across the world, it has been a given. It's also been a key local growth driver, as demonstrated in the resilience of our manufacturing growth in Singapore. And the strategic importance of tech has, of course, been exemplified, particularly with, I guess, Temasek taking a stake in AEM Holdings, which AEM Holdings in return is looking to deepen its R&D, accelerate its product portfolio expansion, and so forth. But what I wanted to point out was that Singapore's most traded tech stocks, they've generated highly competitive returns in recent years. The 5 most traded technology stocks here in Singapore that have a 10-year trading history have generated similar performances to global technology benchmarks. The 10-year average annualized returns, they range from 18% for venture right through to 51% every year for those past 10 years for AEM Holdings on average. The 5 stocks saw their combined market value triple over the 10 years. I think AEM saw the greatest increase in market value, growing from something like $20 million market cap 10 years ago to $1.1 billion market cap now, on the back of its share price gaining something like from 6 cents to above $4 at the moment. So there has been also a journey of these technology stocks that have been just as exciting or just as vibrant off the exchange, particularly with the deep or the homegrown deep tech firm, I should say, Nanofilm, which is basically a really strong testament to the supportive ecosystem that Singapore does have for its tech startups. In the shape of things to come for technology, this year the Global Innovation Index ranks Singapore the 8th most innovative nation in the world. The World Intellectual Property Organization maintains this index, and it provides global stats that show in Singapore, digital communication, consumer technology, electronic machinery, med tech, as well as audiovisual technology have led our 9,500 patent publications from 2010 through to 2020. And the Intellectual Property Office of Singapore also maintained that the IP strategy, the Singapore IP 2030 strategy, will also provide a conducive environment for these enterprises to innovate and grow. Okay, the EDB also noted in late October that business sentiments in the manufacturing sector do remain positive amid the COVID-19 years that we've had, and obviously remaining positive with the pressure on supply chains as well. I think they noted that within the manufacturing sector, the electronics cluster is the most optimistic. I think there was a net weighted balance of more than 25. It was 27% of firms expecting a better business situation for the next 5 months compared to the third quarter of this year, with optimism largely led by the semiconductor segment, which continues to expect robust demand from the 5G market, the cloud services, and the data centers. But for the region, I think consumer markets and supply chains, they have been subject to very significant restructuring, which has been very much influenced by the rise of the Asian consumer, with developments driving trade growth such as technology, communication, and e-commerce. And the IMF estimate, I think 2/3 of the world industrial robots are here in Asia, and the share of retail sales taking place online is 1.5 times higher in Asia than it is in Western Europe or the United States. Hence, automation and e-commerce are both playing a key role in facilitating the region's high household savings to consumer-driven growth. So I think with that, I'll end it. And just to point out, of course, there's our investor resources. As I said, there's a great interview with the Alliance Healthcare Executive Chairman that my good friend Jennifer Tan put together in May that is that you may want to read, or if you would like to know a little bit more about the key drivers of these stocks that were basically outpacing the market in between the highs of the STI, please go to that link and you can read about it in the online reports. But I'll end it off now. Thank you so much, Eugene. I'm really looking forward to this next presentation.
Thank you, Geoff, for sharing. And next, we are pleased to welcome the representative of Alliance Healthcare Group Limited, Dr. Barry Tan, Executive Chairman and CEO, and Ms. Karen Z, Chief Financial Officer. They will share with us more about the company. Ladies and gentlemen, please.
Hi, Eugene, can you see my screen?
Yes, it's good.
Okay, great.
Right, great.
I think thanks, Eugene, for the very kind introduction. Good afternoon, everyone. I'm Barry, and I'm Dr. Barry, and I, together with four of my good friends, we started Alliance, I think more than 27 years ago. So now Alliance, we now hold 16, we own and operate 16 GP clinics, 5 specialist clinics, and also a wholesale pharmacy. At the same time, over the years, we are also leveraging on digital innovations to develop new business model in the healthcare sector. And one of these model is a platform business solutions. So we now own and operate 3 platform business solutions in managed healthcare, mobile health, and also virtual health. Let me now walk you through what exactly I was saying. So in managed healthcare solutions, we develop a IT platforms which connect more than 1,000 clinics in Singapore to provide medical services to our clients. And who are our clients? Our clients are employees of our corporate clients or insured members of our insurance partners. And these clients, they can visit these 1,000 clinics and enjoy cashless medical treatment. And at the end of each consultation, the clinics will then submit the claims through using our system. And at the end of the month, we will collate these claims. We will then check through to make sure that these claims are valid. And then we will get payments from the payers, and then we reimburse the clinics. We charge the clinics a small token fees of administrative fee for every claims that we process. So this is an example of platform solutions. And through this approach, it allows us to quickly scale up our ability to provide a wide scope of medical services to a large populations. And our partner clinics are private GPs, specialists, dentists, TCNs, physicians, and other allied healthcare service providers. We are also linked to the government restructured hospitals. Currently, our clients can go to visit 11 of the GRH and enjoy cashless treatment at specialist outpatient clinics. And these platform solutions has matured over the year. There are more and more corporate clients coming on board our platforms. And during this pandemic period, the number of visits to our panel clinics have dropped because of the pandemic. Nonetheless, all right, the number of corporate clients continue to grow. And in fact, I think we've grown by another 800 over corporate clients over the last 18 months. Our second platform solutions is in mobile health. And through our subsidiary Jagami, we developed platforms that connect more than 500 independent healthcare professionals to provide mobile healthcare services to our clients, either at their homes, workplace, or at seminars. And during the last 18 months, since the start of the pandemic, we have been deploying these resources to provide nursing support at nursing homes and dormitories, conduct large-scale COVID swab in the communities, and going to the homes of our seniors to provide COVID-19 vaccinations. And the latest is that we are also involved in the home recovery program. And also during this pandemic, we also have tied up with government cancer centers, in which we help them to provide some form of cancer treatments at patients' home. And with this arrangement, the patients no longer have to make weekly trips to the hospitals to receive their treatments. And I must say that this program has been very well received, and it has been expanded from 1 to 9 lines of medications. So this is an example of platform solutions in which we don't really own and employ all the healthcare professionals. These are actually independent licensed healthcare professionals. We basically help to connect them to people who require the services. Now, we do have our own team of medical professionals, a small team of doctors and nurses. Their main responsibility is to develop the clinical protocols, provide the trainings to the locums, and also offer the supervisions to ensure the standard of care. The third platform solution is in virtual health. We have developed a teleconsultation platform in which healthcare professionals can provide teleconsultations. And once again, we do not necessarily have to be the one providing the services. These could be independent healthcare professionals providing GP consultations, nutritional advisories, counselings, or even home care services. What we do is that we operate the platforms and we charge a fee for every transaction that takes place in the platform. And beside these three platform solutions, we also innovate in other areas, basically to improve the connectivities, to ensure that healthcare is delivered in a seamless and a frictionless manner. So for example, we have developed a B2C apps in which our patients can connect with their doctors by using this app, whether to get an appointment, get a remote queue, or to seek teleconsultations. We are also developing a unified electronic health record that can potentially link doctors, whether GPs, specialists, or mobile care teams together on the same platform so that we can better communicate and coordinate our care for our patients. And last but not least, we are developing a data analytic engines so that we can systematically collect, analyze, and derive business insight from these data. So I think in short, you can see that Alliance is a company that is undergoing digital transformation from the very traditional healthcare company to a digital health company. And the reason we are doing this is actually quite simple. I think if you look at the pace of digitalizations in the world, in Singapore, right, the demands for very convenient, personalized and highly accessible care is growing every day. And we really want to leverage digital innovations to be able to create and capture some of this value. And that helps us to continue to propel the growth of our company. I think with that, I shall pass the mic to my colleagues, Karen.
Thanks, Dr. Barry. Let me set up this. Hello. Eugene, are you able to see the slide?
Yes, it's good.
Okay. Thank you, Dr. Barry, and thank you, Eugene. Good afternoon, everyone. Thanks for attending this webinar. In the next few slides, I'm going to present some of the key financials of Alliance Healthcare. First, this is a snapshot of the financial performance of the group for the financial year 2021. Compared to the last year, the revenue increased by 3.6 million to 46.4 million this year. The increase was mainly attributable to higher revenue from pharmaceutical services, the specialist care services, and also the full year contribution from our mobile and digital healthcare segment. The increase was partially offset by lower revenue from our GP clinics, which was affected by a decrease in patient volume, largely due to the COVID-19 pandemic. Due to the impact of the COVID-19, our business, especially the GP clinics and managed healthcare solutions, we recorded a lower profit to owners of 1.5 million as compared to 2.3 million last year. Accordingly, the EBITDA decreased by 0.2 million to 5.5 million this year. Due to the lower profitability from our GP clinics and management healthcare, our EPS dropped from 1.12 cents to 0. At the group level, the overall revenue increased to 46.4 million this year. So we look at this of our GP clinics and also a comparable revenue in our managed healthcare solution segment. Our group recorded a higher revenue for our pharmaceutical services, specialist care services, as well as the mobile and digital healthcare services. Revenue for the specialist care increased by 0.9 million to 9.8 million this year, as demand for specialist care is more resilient as compared to GP clinics. However, it varies across different specialists as well, because as travel restrictions impacted those clinics who were seeing a bit of foreign patients. Revenue for the mobile and digital healthcare services increased by 3.2 million to 4.4 million this year. This was mainly due to the full year contribution from this business segment, as well as increased revenue from the Jagami generated for the provision of COVID-19 related medical services, such as vaccine at home and mass swab testing. For the percentage of contribution, in terms of percentage of contribution, although our traditional traditional business in GP clinic, pharmaceutical, and specialists still the main contributors, the contribution from our platform services, being management healthcare solution and mobile digital healthcare solutions, has increased from 14% overall last year to about 21% this year. This growing reinforced our belief on the importance of digitalization and mobile healthcare. We will continue focus on this area, improve our digital platforms to provide an ecosystem of comprehensive healthcare services, come up with relevant and innovative solutions to better serve our clients. Zoom into each of the 2 half years of FY 2021, our revenue for the second half year has been improved and recorded a growth of 0.2 million to 23.3 million as compared to the first half year. So the sales we can see from here, the sales from GP clinics and managed healthcare solution, as well as the specialist healthcare, has picked up during the second half year. It shows a positive sign of recovering of our business from the COVID-19. However, we also see some normalization in revenue from our pharmaceutical services in the second half year, as some of the hospitals reached their storage capacity and were slightly overstocked in anticipating of supply chain disruption. However, we also see some supply chain disruption in certain medications, which act as an opportunity for our business as well. Looking at the cash flow of the group, we maintained a healthy cash flow, net cash of 9.9 million, and generated a positive operating cash flow of 4.7 million. And we incurred a capital expenditure of 0.9 million in FY 2021, which was mainly to purchase one additional office unit and also improve our IT system to enhance our digital platforms. We will continue to invest and improve our digital platforms to enhance our platform solution. At the same time, we will also improve our warehouse facility to cater for special storage need for certain medical supplies. Next, we have a glance at our balance sheet financial statement of as at 30th June 2021. The group maintained a strong cash position of 16.7 million as at 30th June 2021. The current asset increased by 3.5 million to 33.2 million. The loans and borrowings has decreased as a result of repayment during the period. The current liability increased by 2.7 million to 21.9 million as at year end. The total asset increased by 3.5 million to 49.1 million. And also the total liability increased by 2.4 million to 28.6 million as at 30th June 2021. With the current year's profit contribution of 1.5 million and dividend distribution of 0.7 million, the shareholder equity increased by 0.8 million to 19.8 million as at 30th June 2021. This last slide shows our operating cash flow and some of the financial ratios. So as mentioned, the group maintained a positive operating cash flow of 4.7 million during the year. The current ratio of 1.5 times as at year end, which is comparable of 1.6 times last year. The group maintained a low gearing ratio over the years. With repayment of loan and higher purchase, it reduced to 0.3 times as at year end of 2021. With the current year's profit and the netting of dividend distribution, the net asset value per share for FY 2021 increased to 9.52 cents per share. However, due to the decrease in profitability, the EPS for this year decreased to 0.74 cents per share. We believe that the pace of reopening of Singapore economic should be positive impact our group's business, particularly our managed healthcare business solution and also the GP clinic services, as we anticipate more visit to our self-owned or panel clinics. We also believe that digitalization and information technology will play an important, increasing vital role in the healthcare sector. We will constantly improve our digital platform and technology to innovate our solutions to better serve our client, being our patient, our insurer, employees of the corporate clients. That's conclude of my presentation. Thank you. I shall hand over to Eugene.
Thank you. Thank you, Dr. Barry and Ms. Karen. We will proceed to the Q&A session. You may post your question in the comment section below, and due to time constraint, we will endeavor to answer them. Can we have the moderator, Mr. Benjamin Goh, Head of Research, SIAS? along with the representative of Alliance Healthcare Group Limited, to kickstart this session.
Thank you very much, Eugene. Welcome to Dr. Tung as well as Karen. Very happy that you guys are able to join us today. We do have a couple of questions that were pre-submitted, and I think we do have two questions coming in from Facebook. Let's kick off with the question about Alliance Healthcare's digital strategy. So, Dr. Tung, you talked at length about the apps that you're developing, as well as the acquisition of stakes in Jagami, and I really love the name Jagami. Would you be able to elaborate on the company's plan to grow and develop this segment, as well as what do you see are some of the gaps in this segment?
Yeah, I think thanks, Benjamin. I think if you look at the healthcare trends in Singapore, I think there are three key trends that I can see. I think number one is that we have an aging population. So as a result of aging population, the demands for home care will go up. And at the same time, I also feel that there will be decentralization of healthcare services. And there are two good reasons for that. I think one is the land scarcity of Singapore. We cannot continue to build more hospitals or nursing homes. And also at the same time, the pandemic has taught us a very important lesson, and that is not to choke up the hospitals, right? And with right siting our care at the community, I think that is probably the right direction to go. So I think the right siting of care to the community, to the homes, will become an important trend moving forward. And last but not least, our patients in the near future will be a lot more affluent, a lot more tech-savvy. And their demands for very convenient and personalized healthcare delivery will be given kind of expectations. And that's the reasons why it actually so-called propel us to develop some of these digital solutions.
I guess that's more or less in line with some of the bigger markets. For example, in China, many years already, they've had this, I guess, this practice of being able to speak to a medical professional through the internet and all that, right? So I guess it's not that exotic anymore. Okay, so thank you very much for that. We do have a question coming in about the, let's see, the financial performance. So the question reads, digital healthcare saw a surge this year due to COVID-19. In your view, is performance sustainable? It's a financial performance due to, digital healthcare. Is that going to be sustainable?
I think in terms of the increase in revenue, it does come quite significantly from the COVID-related services. But also interestingly, we are seeing a trend where the hospitals are trying to right-side patients to the community, to the home. I shared with the audience just now about initiative that we had with public cancer centers, in which we help to give some form of cancer treatments in the community. And I do think that these trends will continue to grow, and that will help to sustain or grow the demands for home care services. And with regards to COVID-19, I do not think that it will die off very soon. The reason is because as Singapore continue to reopen, we are, unfortunately, but unavoidably, there will be more COVID-19 patients who are on home recovery. And I think our Jagami team is currently very much involved in the home recovery programs.
Okay. Related to that, from the same participant, the question is, would you say that the worst is over for Alliance Healthcare in terms of the impact of COVID-19 on the GP and managed healthcare segment?
I think just now, Karen has shown in financial year 2021, the second half versus the first half result. And you can see that in second half, the revenues for the GP and the managed care sector has grown as compared to first half. And that could signify the recovery process. And I would say that the recovery process is still ongoing. And as Singapore continues to reopen, I think we we'll be heading back, hopefully, to the pre-COVID level.
Okay. All right. So just zooming out a little bit, since we are on the topic of financial performance as well as business strategy, we do have a pre-submitted question. So as Alliance Healthcare scales up and expands, what are some of the avenues for the group to improve on its cost efficiency as well as profitability? And related to that would be, what are some of the safeguards to ensure that Alliance Healthcare does not overpay for its acquisitions?
I think if you look at our business segment, you can broadly divide into probably two groups. One would be the traditional healthcare services, such as the GP specialists and the wholesale farm. And another group would be the digital or the platform-based kind of solutions. And I hope that I was able to impress upon the audience that these platform solutions are actually very scalable, right? The reason is because we don't really have to be involved in owning and operating these facilities. And I would think that as we continue to strengthen our platform solution, just like what we have done for our managed healthcare, we will be able to drive down the cost and improve the yield. Now, on the second questions on acquisitions, when we look at the targets, I think we are looking at very suitable targets that fit into our long-term strategy. I think when it comes to value, it is beyond just the amount of profits they can bring to Alliance. It is also their management talents in terms of their unique skills that currently Alliance is lacking, and ability to have that speed to market for us to reach out into certain market segments that we want to go. So this to us, these are intangible values to us. And we are also looking at promising SME at their early phases, so that we don't have to incur very high valuations. And yeah, and of course, like any other negotiations, I think at the end of the day we must have that ability to just walk away from any negotiation if the price is not.
So a point of to note for our viewers out there, whenever a company acquires a different company, there's always going to be some goodwill. It's just like when you want to buy a HDB flat, there's always going to be cash over valuation. That's how you entice the company to sell it to you. So you know, having goodwill on the balance sheet is very normal. So don't think that the company is overpaying. It's very normal. All right. So and we do have a question here about let me just quickly read this one. So as a healthcare provider, Alliance Healthcare has a reputable standing in Singapore. Can the management share examples of how it has successfully addressed ESG considerations in its strategies as well as operations?
I think in terms of strategies wise, I think I've shared with the audience that yes, certainly we are still growing our engine A, which are our traditional business, but at the same time we are also we're also adding another growth engine in terms of the digital healthcare services, and I think that will help us to achieve sustainable growth in the future. In terms of operations, I think patient safety is of utmost importance to us. So, for example, maybe I would use a very simple example where we can all understand. If you visit a GP clinic, right, whether you're allergic to a certain medication is actually very important. Right? So I think we try to institutionalize the processes so that we don't make mistakes. So if you do come to the My Family Clinics, we will be probably asking you for drug allergies when you register with us, when you are seeing a doctor, and before you collect the medicines. I think this is actually an institutionalized process that we put in to ensure or to minimize mistakes from happening.
Okay. So, but specifically for ESG, things like ethical, social, and governmental factors, right? Is there a specific approach or strategy that Alliance Healthcare is embarking on?
I think in the area that we are working on, I think the respecting and protecting patients' data is of utmost important. I think this is an area that we are putting a lot of investment. So essentially, we are looking at how do we collect our data, how do we store, how do we dispose of the data, and look at where are the possible gaps, where are the possible risks, how do we devise the right policies, the workflows, and also making the right IT investment to actually close out some of these gaps.
Okay.
But Benjamin, let me just tell you, no matter how much investments, nobody is totally free from hacking attacks. Yeah.
Well, yeah, I mean, I've personally been the target of a hacking attack. One of my accounts was hacked previously, but anyway, well, we'll do what we can because obviously cybersecurity is a big issue and there's always lapses. Even Microsoft was hacked recently, right? It's like crazy. But anyway, so those are all the questions that we have. So thank you very much for your candid responses, and we're always very happy to have you on board with us.
Thank you, Benjamin.
Over to you, Eugene.
Right. Thanks, Ben and fellow panelists for being with us this afternoon. We have come to the end of today's webinar. It's been a pleasure to have you with us today. In case you miss any part of today's session, you can rewatch the webinar on SIAS Facebook page and like our page and check out our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a great day ahead.
Thank you.
Thank you. Thank you, Alliance Healthcare.
Thank you, Eugene and Benjamin.
Thank you.